and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's Headline Blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Friday will mark the 30-day mark of the 90-day postponement and 10% cap on reciprocal tariffs. And we're looking at a situation where in Q1, a lot of companies stockpiled inventory ahead of Liberation Day. And again, if we don't see some tariffs come down quickly, I think we're going to see some notable hiccups by the end of the month. So I think the equity market's a little bit ahead of itself in this rally.
Tariffs are engineered to encourage companies like yours to invest directly in the United States. Hire your workers here, build your factories here, make your products here. You'll be glad you did, not only because we have the most productive workforce in the world, but because we will soon have the most favorable tax and regulatory environment as well.
Footwear company Skechers said today it had agreed to be acquired by investment firm 3G Capital in a deal worth $9.4 billion. Shares of the company surging amid the news that it will go private for $63 a share, up over 25%.
We got an hour to go until the market close, so let's take a look at the major averages. Josh, we have kind of a mixed picture going on today. On the one hand, we did have one economic data point this morning, the ISM services or non-manufacturing reading coming in better than expected. On the other, we have still some tariff rhetoric hanging out there. The Dow up by 58 points, but it is coming back towards the unchanged line. The S&P 500 in the last little bit taking another little tick down, off by 0.25%, so ending its 9-day winning streak that it had been on, and the Nasdaq down about 1/3 of 1%.
Yeah, and the S&P 500, so even taking a bit of a breather here today, but that's after, of course, a very strong recent run. Couple different cross currents, as you mentioned, Julie. Obviously, trade is always front and center. You did have some Trump officials giving interviews to the press, and they were seeming to suggest that maybe some good news on deals could be on the way, which felt like it mirrored what Trump was suggesting over the weekend. So I think investors are waiting on that to the extent that we see any kind of details on that. And then to your point, economic data. I mean, the April ISM services did clock in better than expected, and I think some economists were saying, okay, well, they took that as somewhat reassuring because, okay, it seems like it's at least holding up for now in the face of this potential tariff shock.
Right. On the other hand, the president floating the idea of imposing tariffs on movies made outside of the U.S., even, so that's a little complicated because many movies are partially made outside the U.S., so how would that work? This just doesn't seem to me that there's much meat on the bone at this point. It was something he floated, but it is having an effect on some stocks today, and we're going to get more to that a little bit later on with our Alexander Canal. But if you take a look at the stocks that are moving today, here too it is mixed. Even within the NASDAQ 100, Apple moving lower here by 2.5%. That is worth mentioning. Also, want to point out in terms of what we are seeing in the Dow here, if we equal weight it, we'll get a better look at some of the big movers that we are watching here. Apple, Chevron, Amazon taking a hit in particular here. So that's something to keep an eye on. And then on the sector end, we have communication services doing okay today, energy falling. OPEC Plus, as expected, did boost its production targets. And that even though that was expected, we are still seeing that cause a little bit of a pressure today.
Yeah, oh, by the way, the Fed's being this week.
Oh, yeah.
That too, yeah. For more on the latest market moves, let's welcome in now Tim Urbanowitz, Innovator ETF's Chief Investment Strategist. Tim, it is good to see you as always. So you say, Tim, for investors, there are 3 potential scenarios to think through in the months ahead. Walk us through, Tim, to start, what those scenarios are exactly.
Well, Josh, it's great to see you. And right now, we think it is incredibly important for investors to prepare their portfolios for maximum flexibility. Nobody knows the end game when it comes to tariffs. I'd venture to say not even the president himself. knows the end outcome. And this could go many different ways. On the bullish side of the spectrum, we could see very significant deals struck with all major trading partners, which could very easily push the S&P 500 up into 64, 6,500 range. You could see legal challenges to these tariffs be successful, or you could see the president start to walk back some of what he's laid out thus far this year. That's the bull case. Very good odds of one of those three playing out. And then on the bearish side, which is almost equally as important to be paying attention here, you could see deals struck with just some of the minor trading partners. There's a lot of hair on deals when we look at things like China or the EU. If that happens and those tariffs stay on for a long time, a recession would become our base case, in which case you'd see valuations derate meaningfully. We could easily see the S&P going back to that 41, 4,200 range. So right now, a lot of question marks. Need to prepare that portfolio for maximum flexibility.
So how do you go about doing that? I mean, because these, even though there might be some bleed over from some of these cases to one another, right? There might be some from column A, some from column B, but it seems as though there might be quite different outcomes in markets depending on what happens here. So how do you prepare your portfolio for any one of them to happen?
Yeah, I think there's a couple different options here. One would be looking at specific names in the market that are going to be more insulated. When we look at names like Microsoft, where they sell software, right? They're not going to be as impacted by the tariffs. They're also in the midst of this AI trade, which we don't think anything is slowing that down. You heard a lot of the spending announcements on recent earnings calls from the Metas, Amazons of the world. That trend is going to continue. So finding gems or diamonds in the rough like that is one way. We're also seeing a lot of interest from investors moving into strategies that help cover you on the way up and the way down. One idea that has been very popular this year, managed floor ETFs like SFLR, where you're targeting a 10% floor against losses on the downside. And then if the market goes up, you're participating in 70 to 80% of the gain. So we see both of those methods, really finding those stocks that are going to be more insulated, and then also hedging with options-based strategies like SFLR as really a good way to manage around and prepare for a wide range of outcomes.
What about retail names, Tim? I mean, look at some of those names. They have been hard hit. You think broadly, is a lot of the bad news now priced in?
I don't think so, Josh. Those are not the diamonds in the rough. I think we want to be very cautious on a lot of those names. You're going to look at either demand being hit or margins being hit if tariffs go into effect. So I think there's still a lot of unknowns. Retail names are going to be very vulnerable to that. If you look at the move that we saw post-Liberation Day, retail stocks got hit a lot harder than the broad market. So in this environment where, yes, there's a lot of chatter about good news, we still don't think that's a done deal. It's not locked in. Retail stocks are not the way to go here.
And what about, now we're coming off of a couple of weeks where we heard from a lot of big tech, and it was a pretty mixed picture when it came to big tech. So then how are you approaching that group now, Tim?
Well, I think it depends on the name. It depends on the different business lines that they're in. Overall, we still do think, especially like the bigger ones, we look at Amazon. You have so many different business units. The cloud, Amazon Web Services, we think is still going to do extremely well, given the AI tailwinds that you see. While on the other side, the retail side is probably going to take a little bit of a hit from demand if these tariffs do go into effect. So overall, we do think up in quality is still the way to go, which a lot of those mega tech names are. So probably one of the best places to be if we look at this market over the next 3 to 6 months.
Tim, Fed meeting this week. What do you expect to hear from Jay Powell?
Well, we don't expect any rate cuts. And Josh, we don't think there's going to be any rate cuts probably until September. I think the Fed is in a good spot right now. They are very flexible in what they can bring, and they can really sit back and be patient, see how things develop, how much the economy takes a hit from a lot of the fiscal policy and the tariff announcements that we see. So Powell and team, we think are in a very good spot. We don't think they're going to cut. And, if they were to cut, Josh, we would be a little bit concerned of that. If you look at the intermediate longer end of the curve back September through December of last year, when the Fed cut 100 basis points, you saw those yields move up anywhere from 70 to 90 basis points because that was spooking the bond market. They were getting more concerned about inflation. That's not something that we want to see. We don't think the Fed goes that route. But right now, we see them comfortably sitting in a pretty good spot to be able to react one way or the other.
Tim, lastly, and sort of switching gears here, of course, this weekend, Warren Buffett announced at the end of the year he's going to be stepping down as CEO of Berkshire Hathaway, the company that he took over in 1965. And obviously, he's an investing icon. So I was just curious whether you think some of the lessons that he has talked about over the years are still applicable in today's markets, and what's sort of most pertinent or relevant as far as you're concerned.
Oh, Julie, we've been using a lot of Warren Buffett quotes here with a lot of our advisors here. And one of the biggest ones, which he hammered home this weekend as well, was just how patience wins over the long term. You have to be patient. You have to invest in good quality businesses. And I think when we're in this announcement here with just waiting on this, what the end result is of this 90-day pause, you have to be patient. You have to find ways to stay in the market, to stay invested. And when others become fearful, you look to capitalize.
Tim, thanks so much. Appreciate it.
Great to see you, Julie.
Berkshire Hathaway shares sliding as CEO. Warren Buffett said he plans to step down as CEO at the end of 2025. He's still going to be chair of the company, though. So we're taking a look at how shares have outperformed the S&P 500 over the decades. Yahoo Finance's Josh Shaver joining us now with more. And as we just heard Tim say, patience pays off. If you were an investor, you've been rewarded.
Right? I think Warren Buffett is definitely considered a patient investor. And when you take a look at how Berkshire Hathaway shares have performed since 1965 against the S&P 500, you certainly see that patience pays, right? Berkshire Hathaway stock has increased over 5 million% going back to 1965. That's compared to the 39,000% that you see for the S&P 500. I mean, the chart is candidly just pretty staggering when you take a look at the difference in performance there. And I think I was looking through also just the different years that Berkshire has either outperformed the market, underperformed the market, kind of trying to get some takeaways from within that. And what I found interesting within that report, within there, they include this in their annual shareholder letter. And within that, you see that most times that the S&P 500 has fallen, I counted about 13 going back to 1965, Berkshire's only underperformed the S&P 500 in those years twice. So sort of my takeaway from that being, speaking of patience, one thing Buffett's always done is he's not always fully invested, right? He was talking a lot about this on Saturday, not the need to not always be putting all of your money to work, which is not necessarily how most fund managers would operate. You don't give Berkshire a pile of cash and they have to go invest it for you, right? He's waiting and choosing good investments and choosing the right time to buy a company. And I think over time that's paid off. And then also not selling winners, right? He's held on to American Express forever. He's held on to Coca-Cola forever. Yes, he started selling Apple, but he held on to Apple for about a decade. And so just the compounding nature of holding on to those stocks for a long period of time shows that picking stocks to some extent can work, I guess, at least if you're Warren Buffett.
If you're really good at picking stocks.
If you're Warren Buffett, if you're the best investor ever, then you can do it. Yeah.
Josh, thank you. Appreciate it. We're just getting started here on Market Domination. Coming up, our Milken Conference coverage kicking off today. Brian Sazi sat down with Pershing Square Capital Management CEO Bill Ackman. We'll hear that on the other side. And after closing bell, it's another round of earnings reports. We'll get you the latest from Palantir, Ford, and many others. Stick around. Much more Market Domination still to come.
Yahoo Finance descending on the Milken Conference in California. Special guest here with me right now. That is Bill Ackman, Pershing Square CEO. Bill, good to see you. Big day for your company, $900 million investment in Howard Hughes. Why make this play?
Sure. Well, the story begins arguably when I began my career. Very early on, Warren Buffett, Berkshire Hathaway letters, beginnings of my investment education. And the story of Berkshire Hathaway, Buffett buying, basically control of a textile business and then transforming it over time into a diversified holding company. We know how that story is. It's not really ended
60 years
yet.
later, right?
60 years later, Mr. Buffett finally, remarkably at 94, passing the torch. But that was an inspiration for me. That led me to go into the investment business, and I entered the same way he did. I started a hedge fund, and I became a shareholder activist, which he was. But the business plan was always to get to what we call permanent capital. We took a step in that direction. We took one of our funds public in Europe. But the kind of ultimate investment dream is to have a public company where you could build with permanent capital. You can follow investment principles, and build a business of significance. And that's what Warren has achieved, and that's what we hope to achieve with Howard Hughes. We've had a long-standing investment in the company. It came out of an investment we made in General Growth. We spun out of, when that company emerged from Chapter 11, we spun off a company called Howard Hughes Corporation, which owned the real estate development assets of the General Growth company. And General Growth had acquired a company called Rouse, and Rouse had a business of building small cities, what we call master plan communities. I think of them more like cities, but they're not incorporated cities. In the Woodlands, in Houston, Summerlin in Las Vegas, Bridgeland in Houston, and that business is a remarkable business. But it's not one, it's a long-term play. For the first 14 years, it was consumed a huge amount of cash. Today we generate, the business generates cash. We reinvest that cash at Howard Hughes in the equity of buildings that we need in our various communities. So it's a very good business, much better business than the textile business.
And you'll be executive chairman.
So what we're doing here is, so Pershing, the funds, have a 37% stake prior to today. The Pershing Square Management Company, which is the business that manages our various funds, that's owned by myself and our other partners, and we brought in some strategic investors last year. It's that entity. It's making investment in the company. I'm returning as executive chairman. Ryan Israel, CIO of Pershing Square, is going to become the CEO of Howard Hughes. The rest of the team is going to stay in place. Dave O'Reilly, CEO, and we're going to build a company together.
When could you pull the trigger on the big, I guess the elephant-sized deal that Warren Buffett would always talk about?
We're going to start not with elephants, not rabbits, but small animals.
What are you looking for?
What are we looking for?
Yeah.
We're looking for businesses that have great, durable economic characteristics. It's an uncertain world, so you want a company that can withstand tariffs, pandemics, volatile interest rates, volatile moves in currencies, etc. We look for that kind of super durable growth company. We want businesses that are high returns on capital, that can grow as far as the eye can see, that are non-disruptible. And we're going to look for businesses that of a scale that's appropriate in light of the scale of Howard Hughes. Howard Hughes today, 12 billion of assets, 5 billion or so of equity. And our freely available cash today, call it $1 billion. And then we'll work from there.
How are you, essentially you're building a modern day Berkshire Hathaway. How would you compare yourself to Mr. Buffett in terms of how you invest?
He's got more experience than I do. He has a different approach to health than I do, but I aspire to have his longevity and his mental acuity.
No cans of Coke for you, right?
No cans of Coke. I'm not a huge fan of Coke. I think it's caused a lot of harm. I would say I've learned a lot from him. I would say Warren loves the same kind of business as we do. He hasn't, I would say, generally been prepared to pay up for them. He has very, very disciplined on, I'm not aware of a business he's purchased where he paid more than 10 times basically operating earnings. I would say when we bought Chipotle, it didn't look cheap. Many companies we invested in over time didn't look cheap at the time, but they became cheap very quickly by virtue of growth in the earnings cash flow of the business over time. But I would say very similar principles about how we think about capital allocation, how we think about incentives, how we think about the kind of people we want to do business with, the kind of people we want to partner with. So
you were in that room, or you were at the Berkshire meeting,
yes.
Correct? What was that? For those not there, take us inside there. When you heard Mr. Buffett say he would retire at the end of the year, what went through your head?
So you're in a room with 44,000 people or something like this, all of whom, or many of whom, Warren has completely transformed their lives from a financial perspective. I don't know how many millionaires, 10 millionaires, 100 millionaires, billionaires he's created just by virtue of them owning the stock. But there are also many people there that may not even own Berkshire, but learned from Warren, followed his principles, built careers in the industry. I'm certainly one of them. I don't own Berkshire Hathaway stock today, but I still go to Mecca because I want to reset, make sure my investment values kind of stay the same. I think all the shareholders have been nervously not looking forward to this day, I would say. But what a graceful way to pass the torch, an emotional moment, almost tears in his eyes, I would say. I think his longtime partner, Charlie Munger, passing away, obviously a massive blow. But he still was remarkable. 94, 3.5 hours of Q&A with like a 1 hour break. I mean,
nobody else is doing this.
It's amazing.
What are some of the biggest challenges you think his successor, Greg Abel, will be up against?
So Greg, I think, is a spectacular operator by all accounts. I'm sure he's also an excellent allocator of capital in the businesses that he's overseen. I would say the challenge for him is he's got $350 billion in the balance sheet that Warren Buffett couldn't find a way to spend, right? So that's going to be important. And he's not going to be able to spend it all buying stock back, right? I don't think he's going to pay some crazy dividend. So I think the biggest challenge for him is to find places and ways to deploy that capital intelligently in buying businesses that are not currently owned by Berkshire. Right? It's a different challenge to think about buying a new company for $20 billion versus making the incremental decision to invest in this power asset, or this subsidiary of Berkshire today.
Is that elephant deal out there for Greg?
Well, look, I think, private equity is competitive, 10 billion. They're not competitive at 50 or 100, but the universe of companies of that scale that are willing to be sold, I think is very, very small, right? Most public companies view it as a failure, particularly one of that kind of scale, to be sold. Burlington Northern selling itself to Berkshire was kind of a surprise to me. Most companies of that kind of scale want to stay independent. If they're underperforming, they replace their management, they replace the board, an activist shows up. They don't really sell themselves. So it's a big challenge.
Can Greg keep Berkshire intact, and should he? Because I think one would make the argument maybe Buffett has put so much trust in so many different executives that he hasn't necessarily fired people when they should be fired.
Yeah, so I think there are very compelling arguments for why Berkshire should stay one big diversified holding company. The most important of which is insurance is about half of the value of Berkshire. The flexibility that Berkshire has to invest in insurance company portfolio in equities, for example, comes from the fact that it's part of this extremely creditworthy enterprise. If, for example, you spun off the insurance company, it's of enormous scale today, so it can still do a lot. But it's very comforting to the policyholders of Berkshire's insurance operations that there's a big, huge conglomerate that's uncorrelated with insurance that's supporting, that, if necessary, that company. So I think there's a lot of compelling arguments for it to stay together. I don't know that value would be created breaking it apart, the tax benefits, other aspects. So I say it stays together.
Do you think he could run it better than Warren?
I think to your point, Greg has enormous credibility as an operator, and that was really not, I don't think of operations as Warren's top skill set. I think setting up the conditions for an executive to succeed, creating the right incentives, I think that's absolutely Warren's down the middle of what he does. I've talked to CEOs of Berkshire subsidiaries, and they talk about how Warren, the taking the truly long-term approach, while they watch competitors doing stuff in the short term to make earnings look good, Berkshire is prepared for any of its companies. They don't care what earnings are in the next quarter. They care about, are we building long-term value? That basic principle, I would say, is going to certainly remain. Is there going to be a little more focus on margins, optimizing businesses, not for the short term, for the long term? I would say that wouldn't surprise me under Greg's leadership.
Ahead of this interview, Bill, I was thinking back to some of your investments that you still have in the portfolio. Chipotle,
yeah.
I think Nike.
Yeah.
I just talked to Chipotle CEO Scott Boatwright. Their business is slowing down because of tariffs, he told us. Nike, their big businesses where they make a lot of products, Malaysia and China. Does this worry you as an investor in these companies that trade is really starting to have an impact?
So we care about the value of a business. The value of a business is the present value of the future cash flows. What's going on now certainly could be disruptive in the short term. I don't think it's likely to have permanent effects. I do think it's important that we get through the tariff negotiations quickly. I think it's important that we pause the tariffs, or we certainly take them down from 145 to 20 or something like this. I think that puts us in a stronger negotiating position with China. It puts China in a weaker position. Stronger for us because our economy will be stronger in that world. You don't want to be under the gun, have the U.S. economy weakening while you're trying to make a deal with China. Once we take the tariffs down with China, the Chinese are actually highly incentivized to make a trade deal quickly, because if they don't, they're going to lose many more businesses that are going to move their supply chains elsewhere.
145% tariffs on China. How do you think that impacts second quarter earnings for companies, third quarter, fourth quarter?
It depends very much on the business. Most of the companies we own are not going to be dramatically affected or will be minimally affected other than general economic effects, but not particularly pernicious effects on those businesses. I think what you'll see is if you're like Best Buy, and everyone's stocked up on TVs in anticipation of tariffs, it's a bit like the front loading of COVID. You could certainly see Q2 or Q3, a lot weaker.
I talked to Apollo CEO Mark Rowan, told me that the trade war is damaging the U.S. brand. Do you agree with that?
I think the way that it's been executed has shocked the world. When you shock the world, it creates volatility, uncertainty. Trump has kind of a unique negotiating style. I would say it's good that it's unique, because if it became the only way the U.S. negotiated going forward, I do think it would have issues. He's been effective over the course of his life in getting things done, operating the way he operates. I think people need to understand this is his sort of MO. But I think the United States will still be, I think U.S. exceptionalism is absolutely true. This is definitely the best house in the neighborhood. It's the best place to do business, and I think it's going to become a better place to do business with deregulation, with tax reform, and the resolution of tariffs. And
you're still a supporter, even though the volatility in markets has been there, you're still supporting the president and his initiatives.
Absolutely. I want to see the president succeed, of course.
Lastly, Treasury Secretary Best just gave a speech here, packed house. I want to get your thoughts on this before we go. He said the U.S. is entering a new golden age of economic prosperity for both Main Street and Wall Street.
Yeah.
You're one of the most legendary people on Wall Street, in my view, for the past 25 years. Do you think we're entering that golden age?
I think it all depends on execution, but there are lots of reasons why Scott could be right. We've suffered from enormous bureaucratic waste and inefficiency. DOGE is underway to address that. We have a thicket of regulation that's really holding back growth in the economy. We have the permitting process in America, federal, state, local. There's obviously, I'm listening to the Treasury Secretary speak about the difference between doing business today in Texas, trying to build a plant, and doing business in Illinois. And we need to make it easy to do business in America, and they're working very hard at that. I think they're going to be effective. Yes, we've seen the president, use his influence to address these kinds of issues, and I think he's going to help there. Lower taxes for companies that build things in America, the deals that are being made, the trillions announced of companies and countries that are committed to build in America, and also I would say a inflationary backdrop that's getting a lot more favorable. Energy prices are come way down. Egg prices, if you will. The $2 egg is hopefully a thing of the past. So I think we are absolutely the potential to get there. I'd like to see us through the volatility of the tariffs as promptly as possible. I think that's important.
Fair enough. Bill Ackman, Pershing Square CEO, good to see you. Big news, $900 million investment in Howard Hughes. Appreciate it. We'll talk to you soon.
And by the way, it's not so much the investment in Howard Hughes. That's important. By the way, we're paying $100 a share for a stock that's trading at 65, right? So obviously we think there's a lot of value.
48% premium?
We think there's enormous value in the company. And we're a meaningful, very significant change in strategic direction while maintaining kind of a core engine of that company today, which is the real estate business.
Do you see yourself as the next Warren Buffett? Do you think like that?
No.
No. Okay.
Warren's an icon, and he deserves his own place in history.
All right, so. Bill Ackman, it was a pleasure to see you. Thank you so much, appreciate it. All right, do stick around. Much more ahead on Yahoo Finance.
Welcome back to Market Domination, sponsored by Tasty Trade. We're checking in on shares of the automakers as President Donald Trump's tariffs on foreign-made auto parts began on May 3rd, with automakers receiving some concessions from the administration, but still feeling the heat on others. Trump signed an executive order, remember, formalizing the new rules late last week, which gave some carve-outs to what would have been blanket 25% tariffs on imported auto parts. Everything from foreign-made powertrain components to seats and airbags is affected. Ford set to report earnings after the closing bell today, Julie, so we'll see what they have to say. Forecast, guidance. Ford CEO Jim Farley has been out there as a critic of Trump's tariff policies, but as our colleague Praz Sumeranian points out, he's been recently offering a more conciliatory tone, so we'll see what we see today after the close.
Yeah, the shares, by the way, are up about 2% year to date, but Farley's also talked about giving more details on the specific costs tied to the tariffs. So we'll see what kind of clarity we get from the earnings statement and from the call today on that front.
And remember, GM last week put a bogey on that, would take a $4 to $5 billion tariff hit, so we'll see what Ford is willing to share.
Yes. Well, President Trump's first 100 days in office have brought a wave of uncertainty for what lies ahead for the U.S. economy. A lot of businesses voicing their concerns this earnings season over ongoing trade uncertainty. Ford, one of the many automakers navigating tariffs, is set to report those latest quarterly results after the bell, with investors looking to get more color on the risks that lie ahead. Our next guest saying large suppliers and other industry leaders are finding tariffs harder to deal with than COVID. At least that's what he's hearing from them. For more, let's bring in Huntington Commercial Bank Director of Economics, Ian Wyatt. Ian, thanks for being here. You guys, based in the Midwest, you have a lot of clients in the auto stack, so to speak, right? And you guys just had a meeting with a bunch of them. So what were you hearing from them?
Yeah, we had a few CEOs of Tier 1 suppliers speaking pretty honestly in Detroit. We had a nice forum there, and I got to hear a lot of what they're saying. So I think first, yeah, you're right. In some ways tougher to deal with than COVID. One of the CEOs, I like this line. He said he called it Mr. Miyagi tariffs, tariffs on, tariffs off. And that's their frustration, really, as much as anything. It's how on earth do we plan for something where day to day it just keeps shifting, one way or another. And this is really an industry where product cycles last years. You're planning, production planning over years. And so, yeah, they're very frustrated, I think, with the ability to adapt to this. They say, look, we've dealt with a lot of supply chain disruptions. We've dealt with, not just COVID, but like the Japan earthquake. All these times, the auto industry goes through a few shocks over the years. But right now, this is just day to day. It's really hard to adapt. It's one of the basic challenges there.
Do you think, Ian, bottom line, what Trump wants is he wants more auto manufacturing here. Do you think we ever actually see some American auto CEOs make some really big headline-making announcements, say, like, I have this massive plant in Mexico, and yes, Mr. President, I'm bringing it back to Ohio?
I will say when I talk to companies, like I was talking to a transmission manufacturer in the Midwest, and they were saying like they had more business, they were turning away business because companies even, back in December, January, were looking to bring as much production back to the United States as they could. But what I'll say this guy says, and I have heard this for a decade from almost anyone in manufacturing, is there is a lack of skilled labor. We are not training right people. We're probably not recruiting generally, the college targeted kids who are the ones who have the intellectual capacity and skill set to do the really skilled manufacturing work. A lot of them aren't going into manufacturing. So that workforce in the United States, they're worried about current production levels, honestly. They say most of these guys are age 55 plus. I don't know when these guys are going to retire and women are going to retire, but I don't know where the next generation is coming from. And they're they see that. So I think we can't get manufacturing back more manufacturing back to the United States if we don't have the labor force.
And so it's funny because I was going to ask you about whether you're seeing layoffs at some of these companies, but it doesn't sound like that, at least not with that specific example.
No, I'd say, I think companies have kind of realized that layoffs have their price and maybe they underestimated that price a bit. One anecdote I got from COVID from one company was they said all of a sudden we saw quality control issues we hadn't had before. And they didn't realize there were a lot of little nuances to all their machines that the people working on those machines knew. And once they laid people off during COVID, then those folks during COVID were able to find new jobs. And so when they restarted production, brought people back, and they thought it was a fairly simple job in running this machine or that machine, they didn't realize all of a sudden there was a reason the quality was better. And they had to deal with new quality control issues. So I think this industry is realizing maybe a little more that labor is valuable, but at the same time, it's still a very cost pressure industry. They have a lot of sunk costs from EVs, and a lot of programs in EVs have been canceled. And the part suppliers were building plants to support parts and plants to support new EV initiatives. And so they have that challenge to deal with. And I think the other thing is just, the reality is a lot of times you could have one plant that could supply the world or a large portion of the world with a single part. And to do the same thing in the United States and in Europe and in China, and you're seeing this, you probably have 3 plants that are pretty similar and each of them are operating way below capacity. And fundamentally, this is just raising the cost of production is what it's going to do by not having equipment operating at capacity. And investing in that tooling is a tough challenge, but I mean, they are having that conversation. Do we invest in the tooling? Do we start putting more plants here? And I think the other thing we're hearing from them, the other big theme we heard from them is just the Chinese industry they consider to be an existential threat to the auto industry. Was literally the words they used. So pretty dramatic.
And how do they propose sort of thinking through that and navigating that?
So yeah, this is where it kind of gets a little bit. They partly see tariffs as necessary in that space. So it's not so tariffs bad, tariffs good. It's more nuanced than most of the public takes are. But yeah, I think they're seeing that as a challenge. They see it as they have to figure out a way to adapt. But they think and they highlight that those companies are subsidized by the government. They actually have to share all their IP. I didn't know that. That was something I learned recently, that all their investment is shared essentially in R&D across those companies. And this is really a new challenge that they're going to have to deal with globally. And do you just retreat back to the United States more? I think for most parts makers, though, they're global companies. They have global operations. And the reality is, a supply chain I had an example of a supply chain that starts in Mississippi, a part gets put in another part in Mexico, gets put in, finally assembled in cars in Korea, and then become pretty affordable cars in the United States. That's how the current supply chain works. That's the complexity.
It's tough to disentangle it. Okay, so put all this together for us and put your sort of big E economist hat back on, right? You talk to these automakers, but you talk to a lot of other businesses too that do business with the bank. Are we going into a recession? What do you think, given what you're hearing and also what you're seeing on the macro side?
I'll say certainly the April auto sales data, all we can tell is that it was really good April so far. I mean, we've had, end of March, we saw consumers basically trying to front run the tariffs across durable goods, and certainly in this space. And in general, in the real-time spending data, we're still seeing the consumer holding up. I think when you think of GDP and you break it down, that's the biggest component of GDP. If that holds up, I think we can avoid recession. But I do see investment pulling back. I think uncertainty, whenever you look at research, Bernanke actually did a lot of research in the 80s. That was part of what made him famous on uncertainty. And companies, a lot of times they kind of freeze. They don't know what to do, so they don't do anything. And that's, I think, a challenge for the economy if we do see a big pullback in investment spending, that slows the rate of growth, and we think getting below trend. But ideally, the consumer's still holding up. We still see job growth. Job numbers were good. Right. Wage growth is still solid. You still have the core, the biggest part of GDP is still holding up okay. Even in DC area, I was pulling the card spending data in the DC area, and it was still looking okay.
Yeah. Tariffs on, tariffs off. Ian, thank you so much for being here. Great to see you. Well, OpenAI will be controlled by the nonprofit that started it. That's the word for now from the company. OpenAI, which invented the ChatGPT app, is walking away from plans to become a for-profit company. OpenAI announced in a blog post Monday that its nonprofit would retain control of the company even as it restructures into a public benefit corporation. That decision, a reversal from its moves to complete a for-profit status, and it does come as a surprise. The Public Benefit Corporation, or PBC, is trusted to consider the interests of both shareholders and the mission of the work. The AI research and deployment firm was recently valued at $300 billion and is backed by Microsoft. OpenAI's co-founders include Tesla CEO Elon Musk and originally started as a nonprofit research laboratory on a mission to safely build AI for humanity's benefit. OpenAI faced a number of challenges in converting its governance structure. One issue, actually, is a lawsuit from Musk, who accuses the company of betraying the founding principles that led Musk to invest in OpenAI.
And shares of Netflix, Warner Brothers, Discovery, and other media stocks moving lower today. That's after President Donald Trump called for a 100% tariff on all foreign-produced films. Via Truth Social post on Sunday, Trump speaking today said he expects to meet with some in the film industry.
Hollywood doesn't do very much of that business. They have the nice sign and everything's good, but they don't do very much. A lot of it's been taken to other countries, and a big proportion. And I'm actually going to meet with some because, you know, there's some advantages, I guess, and I'm not looking to hurt the industry. I want to help the industry. But they're given financing by other countries. They're given a lot of things. And the industry was decimated. If you look at how little is done in this country now, you know, you think we were the ones. We used to do 100, not long ago, 100%. Now we do almost like very little. So we're going to meet with the industry. I want to make sure they're happy with it. Because we're all about jobs. That's all what it's very important. It's a big industry, but it's an industry now that's, it's really left, it's abandoned the USA where it started. And we'll get it back.
Yahoo Finance's Alexander Canal joins us now with more. Allie.
Hi, Josh. Yeah, interesting to hear those comments from President Trump. Perhaps a suggestion that ultimately these tariffs, at least the tariffs that he had promised, 100% on foreign-made movies, they won't go into effect as he promised. But there's still a lot of unknowns about this. If we take a look at some of those media companies most exposed, you'll see names like Disney, Paramount, Warner Brothers, Discovery. They were under pressure throughout the day. However, significantly off those session lows. But the news certainly sent shockwaves through the industry at large, which is still dealing with the after effects of the COVID-19 pandemic, along with those recent strikes from the writer side and the actor side. I did have the chance to speak to a few Hollywood producers this morning who told me that tariffs would considerably slow down the industry. Worst case scenario, you could potentially see a complete shutdown. One veteran producer described the tariffs as, quote, insane and devastating. She warned that they could actually wipe out those lower to mid-budget films. So think those independent films that are susceptible to these higher budgets, because that's essentially what would happen. Tariffs would dry up cost. It would really disrupt the global order of things, because making movies now, it's become a much more interconnected experience, from the editing process to the filming process to the distribution process. And on top of that, U.S. tax incentives, they are not enough to offset bringing those films here. There's a lot of really good incentives in places like the UK, Canada, the Czech Republic, and that's why you're seeing a lot of these upcoming blockbusters. They're all filmed in those locations. So this is something that could definitely impact the traditional studios like your Disneys and your Paramounts, but also the streaming companies as well. And Netflix, for example, produces more films than any other studio and derives up to 30% of its viewership from film content. We know a lot of their content is more localized content. So, you know, it's something to continue to track. But again, we don't know a lot about this. It was one post on Truth Social. We've already heard the president wants to help the industry, wants to talk to the industry to try and come to a resolution. But, you know, this was something that folks were not expecting, and it was a scramble.
Yeah, put it on the list. All right,
Yes.
Thanks, Allie. Appreciate it. Well, President Donald Trump offered that unexpected twist in his trade war Sunday evening by floating the 100% tariff on foreign movies. But he did it in a familiar way by hinting that a national emergency declaration could be in the offing to achieve his ends. Yahoo Finance's Ben Werschel joining us now with more, and this tool of this so-called national emergency declaration. Talk to us about that, Ben.
For sure, yeah. One thing we've learned about Trump in these first little 100+ days is that there's a lot of emergencies in his mind going on. He's had 8 formal national emergencies that he's declared since taking office, 3 on his first day in office alone. These are on issues from energy to the border to most notably reciprocal tariffs on Liberation Day. And it's also something he brings up a lot, just even if he doesn't follow through formally. This Hollywood example is just the most recent example. He's talked about California water as an under emergency powers too. It's something that Trump and his team have been studying for a lot of years. The 4 years of Joe Biden's presidency, his allies were focused on emergency powers as a way to get around Congress and to move quickly. And as this Hollywood example shows, they bring up a lot of things under kind of this emergency language, the Hollywood things, even though what we're seeing in the last 4 days, as Ali pointed out pretty aptly, Trump said last night, everyone's going to love this tariff. Hollywood clearly doesn't, and he's backing away. But he's still under this idea of an emergency, which I think we're going to see a lot of going forward.
A preview of things to come. Thank you, Ben. Appreciate it.
Sure thing.
When we come back, you won't want to miss the big takeaways from the trading today. We'll have everything you want to know on our top trending tickers. That's coming up. Now, time for some of today's trending tickers. We're taking a look at shares of Skechers, Tyson, and Twilio. First up, Skechers has agreed to sell itself for a 30% premium to the investment firm 3G Capital. The stock soaring today on the news that 3G will pay Skechers shareholders $63 a share in cash. The deal expected to close in the third quarter of this year. Skechers are a really fascinating company. I didn't know that much about it, but the CEO, Robert Greenberg, is 85. He founded the company in 1992. His son is also an executive at the company, and both of them are going to stay on after this deal, and they're taking a piece of it, by the way. They're also going to be investing in it. So just an interesting little tidbit there.
Yeah, I'm just reading through the analyst research. Piper Sandler saying news is positive for the footwear names they cover, should provide a valuation floor. They said positive laterals for Crocs and Wolverine worldwide. Evercore on that same theme, saying the deal sets a hard floor for valuations across the sector in the near term. Says the deal is a bet on tariff deals getting done and this sector operating profitably long term.
Yeah, I mean, 40% of Skechers stuff comes from China. So obviously it's vulnerable here. It withdrew its guidance in April. On the flip side, 3G rang a bell for me, and that's because this is, remember, the company that was founded by those Brazilian billionaires, the trio of Brazilian billionaires. They don't run it anymore, but they're still invested in it. Remember, they combined Burger King and Tim Hortons, which is now owned by Restaurant Brands. They invested in Kraft Heinz alongside Berkshire Hathaway, although that deal wasn't as profitable for them. Anyway, so it's just kind of interesting to see them all.
Burger King to footwear.
Exactly.
All right, moving on. Tyson Foods sinking today after reporting lower than expected quarterly sales amid weaker demand for beef. Tyson also warned that tariffs could also trigger some sales disruptions. So this one under pressure. They did report better than expected quarterly earnings, but it does look like losses of the beef business. That wasn't focusing. You can see we're down about 8% in today's trade. Bloomberg noting they have lost money on beef sales this was a 6th straight quarter. Severe cattle shortage in the U.S. not expected to ease anytime soon, Julie.
Yeah, I didn't know there was a cattle shortage. Did you know there was a cattle shortage? But Donnie King, the CEO, saying Tyson is managing through the most challenging beef environment we've ever seen. That's really the thing that seems to be hitting the stock here. And analysts are saying it still seems like that beef might be tough, although maybe it's troughing to some extent here. The company has really leaned more into chicken. But apparently because the prices for corn are coming up a little bit, maybe the margins on chicken aren't going to look quite as good as they have been looking either.
Yeah, stock down this year and over the past 12 months. Most on the street still looks like it'll hold here.
Speaking of an analyst call, let's talk Twilio. Those shares getting a boost today. Analysts at HSBC getting less bearish on the cloud communications company, citing early signs of a revenue momentum and a more reasonable valuation. So they go to hold from reduce and raise the target price on Twilio to $99 from $77. Basically, they were encouraged by the recent earnings, but they do remain skeptical, they say, about long-term margin guidance.
Yes, they're going to hold. In terms of the upside risks to that call, they told their clients stronger than expected market or macroeconomic environment. They talked about higher than expected success in new product launches, lower than expected competitive intensity in Twilio's end markets. Stock is basically flat this year, but a bit down, but up about 65% over the past 12 months. Nice run.
It has had, yes.
All right, while we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings reports from Ford, Palantir, and many more. Stay tuned for Market Domination Overtime.